What I think we're seeing right now is back to the real estate market and back to what changes things and impacts our industry on a macro and long-term level, and why people that have a lot more money than us. So hedge funds have been on the market buying stuff in Dallas for years. I got friends that do 300 houses a year for certain hedge funds, and they've been doing it for years.
Yeah.
But what's new is seeing a lot more funds and a lot more Wall Street kind of money coming into markets, not just like Dallas. We're seeing it in Dallas, we're seeing it in Houston, Austin, all of Texas, obviously.
Yeah.
But we're finally starting to see it on a smaller submarket level too, where they're buying smaller houses in smaller submarkets, which is really an interesting new phenomena
Land
in the market.
They're buying. They're like we said. They're buying
Not even-
subdivisions.
Right.
Yeah, like they're
not
buying
stuff that's
dirt.
desired,
And
not desirable
in,
stuff.
in transitional areas, and as you're calling it, submarkets, right? Those that out there know DFW know that Waco is probably the most popular submarket off of DFW, right? And
Right.
It's just because of the TV show
Yeah.
and stuff like that, right? But in between Waco and Dallas are a dozen towns that have skyrocketed in pricing and being like less affordable just because they're driving the price up, because it's the dirt in between the submarket, the hot submarket, and the hottest market, right? So
what's causing that is a bunch of fold. On the individual level, what's causing that is a lot of free market a lot of free money in the marketplace. So to answer the actual question is, in the last 12 months, we've basically printed 25% of the monetary supply in the country. That's not a stable thing to keep doing without having it have an impact on the overall market. By that I mean everything in the market.
everything.
Yeah, everything.
Everything.
You can't print 25% money and expect it to not have an impact in the marketplace. So the immediate impact of that is investors, funds having to place money in order to maintain an ROI that they're accustomed to, and realistically probably maintain a somewhat lower ROI. So,
So as liquidity goes up,
right,
everyone gets okay with a lower return.
absolutely,
Because
it's easier to get money.
Because
So now
it's
I can do
easier
more
to get
deals.
money, so I could do more deals. But then the investor that's placing the money is competing to place their money.
Right.
Right.
So that investor. So then what we're seeing is this money is already saturated in a market like DFW. Like everyone knows, DFW is a solid
Sure.
economy, a solid employment base, a diverse economy, and just a growing area to be because of a lot of different reasons. So this is already saturated. So people like us are then looking outside of DFW to Waco, to other smaller towns that are kind of on the outskirts of a metroplex area.
Yeah.
For short-term gains, for renovations or for rentals. And so I guess the question is, what does that do long-term? That's a different question. So basically, what we're going to see in the short term is continued inflation, I think, in the real estate market. Now, hyperinflation is, I think, technically defined as some insane increase, like thousands of percents. We're not going to see something like that.
Yeah. It's I think it's actually like 50%. It's something crazy, like where it equates to like 1,000%, but it's like 50% increase month over month.
Yeah.
It's something silly like that, right?
Runs away.
That's not terribly likely, even with our kind of reckless economic policy,
Right.
for a lot of different reasons. But we are going to continue to see the need to place that money here. Now,
Do you think we reference Texas, certain states as bubble states, like they're kind of in their own little pocket? Do you think Texas is isolated? And it's odd because I think what we experienced in 8, 9, 10, 11 was, you could fart in Greece and it would totally destroy California, right, or New York. Like you could do something in the other side of the world and it completely hurt the United States. Do you think call Texas a submarket of the 50, right? Do you think we're subject to similar pains kind of going into the next, let's just say, 2 years, because the rest of the world isn't open, or they haven't opened, or right? Like we're talking about lumber. A lot of the lumber comes from Canada, right? And it gets across the border or comes from the northern states and drives down. Do you think as those countries remain closed, it's going to cause us to have like stagnation?
I think, I kind of think not. I think Texas is susceptible in the higher end markets. What drives the real estate market is obviously price, but to a certain extent, and so what drives price is two different things. It's A, affordability, and B, demand for the product. Now, as affordability increases, it tends to also increase the price of the product because more people then flood to that area and have the demand for the product.
Which you're seeing with on your houses
Absolutely.
where houses come in, you list it for 200, and like in our situation, we listed it for 199.9, and we got a 225 cash offer, right? Like,
Right.
you look at that and you're what? And I actually, when I did the comps on that house, it was 160 was like what I thought I would max out, and here we just sold it for 225.
Right.
So that's access to money that caused that, and then lack of product that caused that, and so I was just trying to tie it back into housing.
Right. So in that case, the key that you said there, you don't even realize, I think, is that it was a cash offer on that house.
Yes.
So when people try to compare the market we're in right now to 2007, 8, 9, 10, is there wasn't a lot of cash offers on houses, especially coastal areas, especially San Diego, especially Los Angeles, New York.
The cash offers. I mean, in 9, 10, 11, my listings were on the market for 365 days, 400 days. You were
You
going,
had a party at it.
yeah, and you were going to, we'd go to happy hour when it hit 365 days, like we celebrated. It was insane. But then you had the, for lack of better words, you had the government doling out down payment assistance money just to try to get that inventory sold, right? And you had more foreclosures and REOs on the market, and we were all investors going after them. That doesn't exist right now.
No.
Because there was no money then. And the money that was available was very expensive. And right now we have appreciation, so we have equity, and we have money, and we have the stupidest cheap money ever. So those three things are keeping the market on fire.
I don't know how stupid the cheap money is, because there's stupid cheap money in the investment side. I don't know if there's a whole lot of there's cheap money and there's stupid money, but there's stupid cheap money on the investment side. We've already
Yes.
talked about that with investors maxing out leverage on their houses,
Right.
thinking they're going to make a killing on it. I think on the retail side, I think there's cheap money, and I think it's relatively intelligent. Going back to not necessarily intelligent, but I think it's going to have a stabilizing effect to a certain extent. So we're not having ninja loans. We're not having no down payment. There's low down payment loans, but there's still, you need to qualify for it on an income basis.
That
Back in the day,
that definitely you definitely hammer that home.
Yeah.
I want to just right there. Add that to the fourth column. We don't have stupid loans. Right?
on the retail side.
Right,
We
on
do
the
have
retail
stupid
side.
loans on the investor side. To a certain
Absolutely,
extent.
right. But we not on the retail side.
On the retail side, back in the day, in 2004, 5, 6, we could do loans. The ninja thing was no job, no NI,
No income,
no income,
no assets.
no assets.
Yeah, all you
And
needed
you
was
could qualify.
a
Pulse.
score,
Right.
basically a pulse, and you can get a loan.
You
right?
have a 800 credit score, you're getting a house if you can afford the no down payment because you have an 800 credit score. Oh,
Right.
well, because you don't want to screw up your credit. Well, when stuff hits the fan, if you have an 800 credit score but you can't afford to pay your bills, you have an 800 credit score because you paid off your credit card once a month for the past 15
Right,
years.
right.
It's not because you're actually financially savvy and successful.
Right.
Now, if you can do both, that's cool. But that was stupid in the retail marketplace. What we have now is a little stupid in the investor marketplace, but is it actually stupid? So the question. So I think what I alluded to a second ago. One is, cash. Cash offers on houses. We get cash offers on our houses. They're generally pretty good offers. We don't really care if it's cash, if it's lower, because we just want to make our money. But there is that much cash in the marketplace that needs to get placed. So maybe it's going to consolidate, and maybe the market's going to flop around a little bit. The issue that we maybe have long term is a sort of stagflation instead of inflation, so stagflation is defined as an increase in the asset prices without an increase in the actual economy or in the job force. So we're not really seeing an increase in wages, as far as I know yet. We might have to a certain extent, and we're not seeing massive economic expansion. We're seeing economic expansion that's kind of sensible-ish, but we're not seeing those things correlate to the increase in real estate, mostly because of the free money. So if you have a whole bunch of free money, if you're making buy on having your $100, and all of a sudden someone gives you $25, you're going to put that $25 into the gaming machine. You're going to put it into whatever game you like, crypto,
Right.
A stock
The
market,
casino, whatever. Yeah.
the casino, real estate, whatever it is. Now multiply that by however many trillion we just printed. That's going to go into almost a gaming effect into different submarkets. So even in gaming, there's different games are more or less risky, I suppose. In the short term, I think the upside is in something like real estate continuing to increase because of that supply of money. The risk is if we don't have an increase in economic productivity and if we don't have an increase in wages, then we bump into, even with low interest rates, an affordability issue. And if we see an increase in prices and other stuff, then we're likely to see increases in Fed's rates, which then leads to less affordability in the marketplace.
I think they're petrified
I
to
think so,
adjust to adjust that rate.
But the problem
I
is-
think they built it up like a dam.
Oh,
Well,
it's
that's the problem with what the Fed's doing with their money supply is we think that they just
Wait,
arbitrarily pick
wait.
interest rates.
back up with whose money supply?
Yeah,
Not with
even I
their
slipped up on
not
that.
with their money supply.
With the money supply,
with
with our money supply.
with our money, right? And I think that people are like, oh well, they're just going to print more. No, it's our money that
Yeah.
they're diluting,
They're
right?
just devaluing
Yeah,
yours.
and but that's the economics of that you don't get taught in school, you don't get taught in college. Like you're just this. That's talking about bubbles. That's a bubble that needs to pop.